You're just kind of looking at the market and the speculative environment that we've got going on right now. What we've continued to see, and again, it's running at a very high rate right now, which is this idea that markets don't have any risk. Just buy every dip. It's fine. You're going to do well. Whenever markets pull back, that's your opportunity to buy some more. Don't worry about downside risk. And this is what's been training investors now really for the last 15 years, which again, because of zero interest rates and quantitative easing and bailouts of this, that, and the other thing, and checks to households, etc., we continue to see this advance in the markets. And we've created this idea that I've always got insurance, so just buy the dip. So there's no risk. So this chart this morning was interesting because it shows the returns by just what happens on a down day. So like Friday before last, we had this 2.71% decline in the markets, and markets are higher since then. Now, it's not been a straight return back to all-time highs yet, but they are higher than they were off that dip. So every time the market has dipped, you've been rewarded just by buying the sell-off. And in fact, this is the largest return year for buying the dip in the last 30 years. If you just buy the down days, you've been rewarded for it. We're in this period of low volatility. And when you're in periods of low volatility, markets perform well. When there's no volatility, markets are just going up. You're just buying every dip. But what's important to remember, though, is that periods of low volatility are always followed by periods of high volatility when markets don't work well. So it's easy to get complacent in a low volatility environment. This is that zero risk environment that we're currently living in right now. And this illusion of safety, zero risk, the Fed's always going to bail me out, has certainly been evidenced by what's been going on. So what this chart shows you is the Fed funds rate, that's the red line, and balance sheet contraction or expansion versus the S&P 500. And it's not surprising when the Federal Reserve is shrinking its balance sheet, doesn't mean markets just go down, but markets have a bit more trouble. That was pretty evident in previous cycles. However, since the October lows of 2022, despite the Fed contracting the balance sheet, although that balance sheet contraction has slowed rather dramatically, the markets have been accelerating. This has really been that evolution that occurred following the 2022 sell-off that, oh, Fed's got my back. I'm just going to buy everything. And it doesn't matter what the asset class is. I'm going to buy it and it's going to go up in price. We're now talking about stopping QT. So that's going to stop that balance sheet reduction. So we're going to move back to basically a flatline scenario that's supportive for stocks. Also, the Fed's now cutting rates. We'll see how this works out, but historical correlations have been broken somewhat in the last 3 years in particular, as this speculative surge in the market has really just accelerated to a large pace. But this is the whole definition of moral hazard. I can take risk because I have insurance. What we've trained investors to do is there's a zero risk of loss in the markets.
Catch me daily on The Real Investment Show. The link is in the description.